Hi, I'm Anthony Diosdi. I'm a tax attorney in San Francisco with over 20 years experience in international and domestic tax planning and tax litigation. You can find me at sftaxcounsel.com.
Today we're going to be talking about Schedule J. Schedule J is used by CFC shareholders to report the earnings and profits from a controlled foreign corporation. Category 1A, 4, and 5A filers are required to attach a Schedule J to a Form 5471. Now, Schedule J is probably one of the most difficult schedules and one of the most misunderstood schedules of the Form 5471 schedules that have to be filed along with the form. I review Form 5471s for that other CPAs and other tax professionals have prepared. And I can tell you that this schedule itself creates probably the biggest headache for tax professionals. So let's kind of jump into the form itself and let's see if we can make some sense of the Schedule J. So if you're preparing a Schedule J either for yourself or for another client, hopefully that this discussion will kind of help you through the process of completing the form. All right. So when you're preparing the Schedule J, one of the first questions the Schedule J is going to ask is the category of income that's going to be disclosed on the schedule. Now, if you were to read the instructions, the IRS's instructions for Schedule J, you would find that the instructions do not provide any guidance at all to discuss the types of categories of income that need to be reported on the Schedule J. So what you have to do is you have to look at the instructions for the Form 1118, which is a form that is used to determine foreign tax credits for corporations. And the Form 1118 provides instructions for the categories of income that are reported on a Schedule J. Okay, so what categories of income need to be disclosed on a Schedule J? And let me back up a minute by saying that when you're reporting a category of income on a Schedule J, you report it by a code. There is a certain code that requires you to kind of enunciate the type of income itself that's being disclosed on a Schedule J. So, what are these categories of income? Well, probably the most common income when you're preparing the Schedule J that you're going to be reporting will be Section 951 Cap A category income, and the code is 951A. And this is when your foreign corporation that you're preparing a Schedule J for has guilty income. So if you're reporting guilty on the Schedule J, you're going to attach or you're going to insert code 951 Cap A. In a minute, I'm going to tell you there's an exception to this rule, but just keep this in the back of your mind that if you have guilty income, uh, typically it's going to be reported under 951A. Now, the instructions for 1118, the Form 1118, discuss foreign branch income or category FB. The category FB or foreign branch income, you're never going to have to worry about reporting that onto a Schedule J, and that's because the instructions tell us not to. So if you see this category of income, it doesn't need to be reported on a Schedule J, and just what is it if you need to know? And the foreign branch income is typically when you have a U.S. company that has a foreign branch outside the United States. The next category of income that we're going to be talking about is passive income. Passive income is going to be code PAS. PAS, it enunciates a number of different categories of income, but the most common category of income that needs to be reported on a Schedule J is going to be foreign personal holding company income. Now, foreign personal holding company income is a subset or one of the income categories of Subpart F income. And when a Controlled foreign corporation would have to report this. This would be typically a situation when the foreign corporation is receiving passive income, passive interest income, passive dividends, passive rental income, passive annuities, passive royalty income, or gains from the sale of stock or securities or property that produces interest. This is the type of income itself that would typically be classified as foreign personal holding company income. So if you have a controlled foreign corporation that is receiving this type of passive income, which is foreign personal holding company income, you're going to wind up putting the category PAS on the Schedule J. Now, there's another category of income that I'm not going to go into too much into detail, but nonetheless, you should know about it because it might pop up. And this is when you're dealing with treaty income. If you have a category of income that's resourced because of the utilization of a tax treaty, then you're going to have to go ahead and report it as resource treaty income. And there's a number of different categories of it. And for purposes of saving time, I'm not going to go through it. But if you do have treaty income that the controlled foreign corporation is receiving, then you're definitely going to have to put that in as a category of income on the Schedule J. And then finally, general category of income. If the controlled foreign corporation is receiving subpart F income, for example, and the subpart F income is not foreign personal holding company income. It's one of the other categories of subpart F income. Then what you would do is you report that income as general category income or GEN when you're disclosing a type of income on the Schedule J. There's also going to be another type of general income that needs to be reported on a Schedule J, and that is if you have guilty income, but the guilty income is reclassified. And we're going to be talking about reclassification of guilty income in a bit, but when, let's just say, guilty is reclassified on the Schedule J, you'd not report it as 951 Cap A income, you report it as GEN on the Form 5471 Schedule J for the type of income that it is. Underneath the category of income, the Form 5471 Schedule J is going to ask if there was any type of income itself that is coming from a sanctioned country. So, and what that would be is if you are receiving income from a sanctioned country such as, I don't know, Sudan, maybe Cuba, or Iran, that would be classified as Section 901J income. And if the foreign corporation itself, in an unlikely event, is receiving income from a sanctioned country by the U.S., you would check that box, and there's going to be a two-letter country code that you would enter next to that box itself of where that income is coming from. Now, if you have a situation where there is more than one type of income, let's just say, or there's multiple Schedule J's because there's multiple types of income, you'd enter the code rather than what we talked about earlier, regards to the income of the company of the controlled corporation. You'd enter the term total, and total basically tells the IRS that there's going to be an aggregate of Schedule J's that are going to be filed with the Internal Revenue Service. So now, since we got done with the easier part of the Schedule J, we're now going to move on now to Schedule J Part 1. Now, Schedule J Part 1 is pretty much the meat of the Schedule J. And in order for you to properly prepare the Schedule J, you're going to have to understand a little bit about PTEPs. And what is a PTEP? A PTEP represents previously taxed earnings and profits. What the Schedule J is all about is disclosing different categories of PTEPs to the Internal Revenue Service. All right. So how do we kind of determine how to classify a PTEP? Well, in order for us to determine that, we have to look at Internal Revenue Code Section 959, the 959. So the 959 rules were enacted quite some time ago. So prior to the Tax Cuts and Jobs Act, 959 was far simpler than it is now. 959 really only had three categories of income. And what these categories of income were was under Code Section 959C1 is whenever a foreign corporation that's classified as a CFC had 56 investment in U.S. property, that was so-called classified as 959C1 income. Under 959C2 income, or PTEP, this is when the foreign corporation had subpart F income. When it had subpart F income, that would be disclosed under 959C2. Now, under 959C3, that was basically disclosing the general current accumulating E&P of the foreign corporation. So that's how you started off with these three categories. Now, once the Tax Cuts and Jobs Act was enacted, the Schedule J became significantly more complicated. The IRS started asking a heck of a lot more questions on the Schedule J. And as a result, the IRS and the Department of Treasury issued a number of notices and a number of new regulations under Code Section 959 and made the 959 rules far more complicated. And as a matter of fact, the IRS just issued new proposed regulations to make the 959 rules even more complicated. But what I'm going to do right now is I'm going to try to simplify this and kind of state what the current rulings are under 959 for purposes of getting you through the Schedule J. So the first thing we have to understand is when we're preparing the Schedule J Part 1, the first rule that we really need to kind of wrap our heads around is Section 956. Now, 956 has little, if any, relevance today, and that's because of the deemed dividend deduction rules under Section 245A. But what these rules do under 956 really increase the number of categories that 956 applies. So what is 956? So 956 basically is whenever a foreign corporation has any interest in U.S. property, it becomes taxable. What is U.S. property? Well, U.S. property includes most tangible and intangible property owned by a CFC that has a U.S. situs, such as stock in a domestic corporation, an obligation of a U.S. person, such as a loan, a right to use a patent or a copyright or any other forms of intellectual property in the United States if it was acquired or developed by the CFC for the CFC's use. A CFC is treated as owning a proportionate interest in U.S. property owned by a partnership, which a CFC is a partner. Now, if you are going to run across a 956 type of an income inclusion, the most likely scenario that you're going to see it is when a CFC makes a loan to a U.S. shareholder. A loan itself under Section 956 equals property for purposes of 956 and is a taxable event. So, with that said, what Schedule J did is it increased Section 959 C2 PTIP categories to be disclosed on the Schedule J from one category to five. It also expanded 959 C1 PTIP categories from one to five as well. So now what you have to do is when you're making a disclosure on Part 1 of Schedule J under 959 C1 or 959 C2 PTIP, you're also going to have to go ahead and include Section 909 anti-splitter rules, E&P carried over from certain non-recognition transactions, covering deficits, and you're also going to have to include 965 inclusions. When I say 965 inclusions, I mean 965A and 965B inclusions. You're also now going to have to include guilty income as well. In addition, you're going to have to include Section 245A hybrid dividends and Section 1248 amounts. And we'll discuss what all these terms mean in a minute as we kind of go through the columns and the lines of the Schedule J. So now with this in mind, I think what we're going to do is go through first, we're going to start going through the columns of part one of Schedule J. And then what I'll do is I'll describe what needs to be reported under each column of Schedule J. And then when I get done going through the columns of Schedule J, part one, we'll start talking about the lines for each column and what needs to be filled in. So the first column that you're going to wind up seeing on Schedule J is going to be column A. And column A asks us to basically disclose Section 959C3 earnings and profits. So recall 959C3 earnings and profits, that's been around for a while. That hasn't changed into the new rules. And what that means is that if you have earnings and profits of the CFC, that needs to be disclosed currently. Any current earnings and profits that are taxable for the current year needs to be disclosed under column A. So if you have guilty income, subpart F income, that's taxable in the current year, and that's earned in the current year, that goes under column A. Let's move on to column B. Column B says that any Section 959C3 earnings and profits that have not been taxed, which is post 1986 through a pre 2008 tax years, needs to be disclosed on column B. So if you have a CFC that has retained earnings, and we'll talk about how you can have retained earnings in a minute as well, but if you have retained earnings, that is from post 1986 to pre 2018, you're going to wind up disclosing that E&P that has not been taxed under column B to Schedule J. All right, let's move on to column C. And column C, it's very unlikely you're never going to wind up utilizing column C, but let's talk about it anyway. What is column C? So column C is section 959C3 earnings and profits that have not been taxed that are pre 1987. So if you're dealing with a foreign corporation that has untaxed retained earnings before 1987, it's going to be disclosed under column C. Now, I have not come across a situation where I've had to report anything pre 1987. I've not seen one, but if someone has seen a CFC that has pre 1987 income, please feel free to report it on the comments section. I'd love to hear about it. All right, column D. Column D is used to report hovering deficits and deductions for suspended taxes, which come from the E&P and foreign taxes in certain foreign to foreign non-recognition transactions. So basically a merger between two foreign companies. And then if there is a hovering deficit that results from the E&P and taxes carried, which is carried forward under section 381, the PTEP that comes from this transaction itself is reported under column D. Now let's move on to column E. Column E is used to report the running balances of the foreign corporation's PTEP under 964A that has accumulated since 1962 and results in a deemed inclusion of subpart F income, which is under section 965B4. All right. So the next few columns that I'm going to talk about, columns 1 through 5, this talks about certain types of PTEPs that are reported on the Schedule J, which is related to 956 inclusions, which is related to the reclassification of investments in U.S. property. So E1 through E5, the types of reporting that you're going to have to do from E1 to E5 is repeated again in E6 through E10. Columns E1 through E5 are repeated again in columns E6 through E10, but I'm not going to repeat myself and go through 6 through 10. I'm just going to go through 1 through 5. And the reason for it is that columns E1 through 5, I'm just going to talk about your general PTEP rules. But if you have to complete E1 through E5, you're basically doing it to disclose PTEP, which is related to reclassification for U.S. property type of a situation. Most of us who are preparing the Schedule J will wind up preparing columns 6 through 10 because chances are you're not going to be reporting PTIPs that have anything to do with U.S. property. All right, so just something to keep in mind. Without further ado, let's kind of go through this. All right, so column E1. So column E1 asks you, the return preparer, to report previously taxed income, which is subject to 965A inclusion. So 965A inclusions, this was the transition tax, right? So when the rules changed after the Tax Cuts and Jobs Act was enacted in 2017, the big change was that foreign corporations could no longer have retained foreign earnings anymore. They had to repatriate all the income, or should I say, they had to repatriate all the untaxed E&P. 965 wound up treating it as subpart F income, and so 965A, any income that was repatriated as a result of the transition tax gets classified as a PTIP, and you'd wind up reporting that under column E1 in this case, or if it's not related to U.S. property, it's going to be reported on column E6. So for column E2, E2 is you're asked to disclose 965B PTIP. And what 965B PTIP is that whenever you had multiple foreign corporations and you're dealing with a transition tax and you're using the E&P from one foreign corporation to offset the E&P from the other foreign corporation, the amount of the deficit that was produced as a result of the offset would be reported under Section 965B. You'd wind up reporting that PTIP under column E2 or E7, depending on whether or not you're dealing with U.S. property. All right, the next column that we need to look at is going to be column E3. So column E3 is used to report a PTIP that is attributable to investments in U.S. property or reclassification of U.S. property. Column E4 is used to report PTIP that's attributable to an inclusion under 959A Cat A, which is guilty. Now, for column E4, it's going to be a reclassification. So when you have guilty income that's reclassified as an investment in U.S. property, you're going to report that on column E4. If it's not reclassified, if it's guilty income that's not reclassified, and this is what the bulk of a lot of people preparing these forms and be reporting it, it's going to be guilty income that's not reclassified as investments U.S. property. That's going to be reported under column E9. Now, earlier I talked about general income when you're classifying your income for purposes of the Schedule J. And I said that in certain cases, you're going to be using the gen category. If you are reporting guilty and the guilty itself is reclassified as an investment in U.S. property, for purposes of the Schedule J, you're not going to report the income as 951 Cap A income, you're going to be reporting as general income. Let's move on now to column E5. All right, so column E5, and this is column E10 if it's not attributable to U.S. property. It's an interesting column because the instructions don't tell us a heck of a whole lot of what we report under this column. But what we wind up reporting in this column is a couple things. We wind up reporting PTEP. First of all, that's attributable to a hybrid dividend. All right. So in order to understand how this column works is that we have to understand code section 245 Cap A. And section 245 Cap A allows an exception foreign income of a domestic corporation that is a U.S. shareholder by means of 100% dividend received deduction, which is the acronym of DRD, of the foreign source portion of dividends that is received from the controlled foreign corporation. So with that in mind, that's a pretty good deduction that the Tax Cuts and Jobs Act allowed. However, Section 245 Cap A E denies this deduction if the dividend received by the controlled foreign corporation if that dividend itself is received from a foreign country and that foreign country permitted some type of a benefit, some type of a tax benefit. Either that the dividend itself being paid out from the foreign country was allowed a local foreign country deduction or another tax benefit. In that case, Section 245 Cap A lowercase e will deny the 245 Cap A 100% DRD deduction. All right. And that will generate a PTEP. So if that wound up happening, that amount that was disallowed and paid, you're going to wind up reporting that amount under column E5 if it's related to U.S. property. If it's not related to U.S. property, it's going to be reported under column E10. Now, the other type of PTIP that you're going to wind up disclosing on column E5 if it's related to U.S. property and E10 if it's not related to U.S. property is PTIP that's attributable to a Section 1248 amount. So let me kind of back up and talk about this a little bit more detail before we discuss how this is reported, how does it apply. U.S. shareholders of CFC stock are often selling their shares, just like any other corporation, they sell their shares. And so do corporations that control other CFCs, they sell the shares as well. And just like a U.S. stock, a sale of a controlled foreign corporation stock, it's taxed under favorable capital gains rates most of the time, as long as the stock has been held for more than 1 year. So that allows for a favorable tax treatment. But if the stock itself has built-in dividends, that built-in dividend itself is not taxed at favorable capital gains rates. That dividend itself is going to be taxed under Section 1248 as ordinary income. All right. So you might be asking, well, how are you going to have built-in dividends? Because after the enactment of the Tax Cuts and Jobs Act, it eliminated deferral. So how would you wind up having built-in dividends? Well, you could wind up having it in several different ways. So let's talk about the first way you could wind up having built-in dividends into a CFC stock. The most obvious way is if the shareholder of the stock is paying guilty income. Call or understand that guilty income has a carve out, a 10% QBAI carve out. That 10% is not taxed, at least at the time, it's not taxed under guilty. So over the years, that 10% QBAI amount you could wind up having an untaxed amount that's built into the share itself. Another way is if a CFC shareholder makes a 962 election to be taxed as a foreign corporation for foreign source income. You could potentially have built-in gain there, because what happens is that there's income that's not been taxed. That's the way 962 works. And so I'll have probably another video on this discussing 962, but for now, understand that if someone makes a 962 election, you're probably going to have untaxed amounts on those shares. And then also, finally, if a shareholder takes a high tax exception under guilty or subpart F income, there's a chance that you could have untaxed amounts on those shares. So, in any of these three scenarios, when an individual shareholder of a CFC sells their shares, you could have a 1248 tax liability that would generate a PTEP, and that amount would be reported under column E5 or E10, depending whether it's related to related to U.S. source income or not. And another way of that this could wind up popping up is, let's just say you have a chain of foreign corporations, and then one corporation sells the shares of the other corporation. If there is foreign personal holding company income in one of those corporations that were sold, you could also have a 1248 liability that's attached, and that would have to be reported on the Schedule J under column E5 or E10. All right, so we don't need to go any further into the columns, because the columns itself, 6 through 10, just kind of restate what I just spoke about for columns 1 through 5. All right, so now since we've gone through the columns, let's go through the lines. The lines of Schedule J, which you'd have to basically address under which column you'd basically have to answer each question. So line 1A. So what do you do on line 1A? Well, line 1 asks the filer to enter the balances of each column at the beginning of the year, okay? And when you're entering all these amounts, when you're entering the amounts on the lines or on the columns, one thing I neglected to mention was that you're going to be entering this in functional currency. What is functional currency? Most of the time it's US dollars, but if the books and records of the foreign corporation are in a foreign currency, then you're going to be entering foreign currency on your Schedule J on the columns and on the lines, all right? So Schedule J asks the filer to enter the balances for each column at the beginning of the year. And this amount should equal the ending balance of the Schedule J for the prior year. On line 2B, if there was a difference between this year's balance, beginning balance, and last year's ending balance, then you have to state the difference and have an attachment to the 450, 471. Line 1C, if there's an adjustment, an accounting adjustment for line B, that amount's going to have to be entered on line 1C. Okay, for line 2A, you're going to have to disclose an unsuspended tax amount under Section 909. Recall earlier, I talked about splitters. I talked about this would have to be foreign tax credit splitters that would have to be disclosed on a Schedule J. So what is a foreign tax credit splitting event? Typically, if you have a difference between the taxable income of the controlled company in the US compared to the foreign country, this could be the result of a transfer pricing agreement, or differences in the two countries' tax timing, for example. I mean, the list goes on, but you get what I'm saying. I mean, hopefully you get what I'm saying here is that if there's a difference between how you report the tax in the United States compared to the foreign country, you might get a foreign tax credit splitting event. And if that causes the suspension of the reporting of the taxable income, that amount was suspended previously because of the differences in accounting between the US and the foreign country, and it's unsuspended this year, you're going to report that on line 2. For line 2B, the amount that is suspended because of Section 909 or a hybrid instrument splitter arrangement would be disclosed on line 2B. For line 3, you're going to disclose the current year's E&P that is reported from Schedule H. So when you're preparing the Form 5471, you never should start with preparing the Schedule J first. First, start with preparing your Schedule C and your Schedule F to the form, which is going to be your foreign corporation's balance sheets. And then the next step is to prepare Schedule H. And then once you completed Schedule H and you're on line 5C, you're going to carry over that amount from line 5C from the Schedule H to line 3 of Schedule J. All right, for line 4, what is line 4? Line 4, you should report any types of E&P that's attributable to a distribution from a lower tier foreign corporation. So if you have a lower tier foreign corporation, any distribution amounts from that lower tier foreign corporation should be reported on line 4 and it should be reported as positive numbers. All right, for line 5A, you're going to enter the numbers, or should I say, you're going to enter the earnings carried over from a surviving corporation after an acquisition by a foreign corporation, by the foreign corporation's assets of another. If, for example, the CFC wound up acquiring another corporation through a merger, then the surviving corporation, the current corporation that's doing the reporting, that amount's going to be disclosed on line 5A, and then you're going to go through the appropriate column. Okay, line 5B asks the filer to disclose the E&P deficit of the foreign surviving company. So once again, if you have a merger, if you're dealing with a merger, that's when you'd be completing line 5B. Line 6 asks the filer to attach a statement detailing the nature of any adjustments that is not taken into account by the company's earnings and profits. So if you have some kind of deviation that needs to be disclosed, that'll be disclosed on line 6. Line 7 asks the filer to enter the CFC's earnings and profits at the close of the tax year for any kinds of distributions or inclusions under Section 951A or 951 Cap A. So basically, if you have Subpart F income or guilty income, and there's a distribution or inclusion as a result of Subpart F income or guilty income, you're going to be disclosing that on line 7. Line 8 asks the filer to enter the amounts included in gross income for the U.S. shareholders for Subpart F income or guilty income. Line 9 asks the filer to report any actual distributions in negative numbers. So if there's a distribution from the CFC to the shareholders in the form of guilty or Subpart F income, you're going to wind up reporting that as negative numbers on line 9. Line 10. So line 10, you're going to basically report any reclassifications. So if you had any reclassifications from 959C2 PTEP, recall what that is. 959C2 PTEP is typically going to be your Subpart F income or guilty income, and it's reclassified to 959C1 PTEP, which is U.S. property, you're going to wind up, or interest in U.S. property, you're going to wind up reporting that reclassification on line 10. Line 11 asks the filer to report E&P that has not been previously taxed and is treated as earnings in U.S. property, which is therefore going to be Section 959C1 PTEP. Line 12 asks the filer to attach a detailed statement and nature of E&P that has not been accounted for on line 8 through 11. And line 13 asks the filer to list any hovering deficit offsets from column B from column D, that has been reported as positive numbers. Finally, line 14 asks the filer to state the balances at the beginning of the year. I'm going to just go ahead and talk real quick now about part 2. So part 2, if you had any recapture of subpart F income, you would be winding up reporting that recapture of subpart F income on part 2 of the Schedule J. Okay, so that wraps up our discussion on Schedule J. At the beginning of our discussion, I talked about category filers. If you have any questions regarding category filers, I made a pretty detailed video on category filers. Please feel free to check it out. That might give you some insight to what a category filer is for purposes of reporting Schedule J or any other schedule for the Form 5471. And I'm also going to say that this video itself is not intended to be an invitation for legal services. This video itself is for educational purposes only, and it's not meant to be relied upon by anybody for any usage at all, or relied upon anybody for the preparation of their tax returns. And on that same note, it should be pretty apparent that this is a very complicated form. Schedule J is a very complicated schedule. If you don't know how to prepare the Schedule J, whether you're preparing it for somebody else or you're preparing it for yourself, seek the advice of a competent professional who knows how to prepare the Schedule J. The penalties for preparing the Form 5471 or the Schedule J are extraordinarily steep. The penalties start at $10,000 and they go up to $60,000. And there's also a reduction of foreign tax credits if the form itself is improperly completed. Thank you very much.